Trend lines are key levels that form diagonally during a trending market. You can use trend lines to identify the overall direction of the price. Upwards trend line means bullish, downwards trend line means bearish, and similar to support and resistance. You can also use the trend line to identify possible entry scenarios. For example, if price retraces back to a trend line, it can be a good opportunity to take a buy position. Gann Angles. It is a tool that displays multiple lines that spread continuously on different angles. These lines can then act as possible key levels and could also help you measure the strength of a trend. Price moving within the steep angles of the tool indicates a strong trend, and price moving within the shallow angles of the tool indicates a weak trend. To apply the Gann angles, first you go to Settings, then make sure to check the lock price to bar ratio. Next, identify a market range and mark the swing low and the swing highs off that range. Then, draw a straight vertical line at the start of the range. After that, select the Trend Angle tool and measure 45 degrees. Then, use the Gann fan tool and place it at the 45-degree angle. Momentum indicators. These are the types of indicator that measures the direction and strength of a trend. It is most effective when used in trading markets. Some of the most notable momentum indicators are MACD. An upwards crossover indicates a bullish trend, while the downwards crossover indicates a bearish trend. Moving averages. Price being above the moving average signals a bullish trend, and price being below signals a bearish trend. Parabolic SAR. A dot below the price indicates a bullish trend, and a dot above the price indicates a bearish trend. Supertrend. Green signal indicates a bullish trend, and a red signal indicates a bearish trend. Oscillators. These are the types of indicator that displays the relative strength of a price. It is most effective when used on choppy or sideways markets. Most notable oscillators include RSI. This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community, where you will have access to comprehensive materials and detailed guidance. When the line is in the oversold region, it indicates a possible reversal to the upside. If it's in the overbought region, it indicates a possible reversal to the downside. Stochastic. If both lines are at oversold, it signals a possible reversal to the upside, and if both lines are at overbought, it signals a possible reversal to the downside. These two lines can also cross over each other to predict future price movements. Divergences. Divergences occur when an indicator displays an opposite signal of the real price movements. When this happens, it is usually a sign that the trend might reverse. Divergences can occur in many indicators such as the MACD, Stochastic, and the RSI. For example, here, using the MACD indicator, you can see that the price is forming higher highs, which is bullish, but the indicator shows the opposite, a lower highs, which is bearish. In this case, this is a bearish divergence, which signals that the price may form a reversal, and so you can take a sell position.